US futures are pointing lower on Wednesday, this after the Dow rallied by more than 1,100 points, while the S&P 500 had its best one-day performance since 2018 on Tuesday. We're in a highly volatile period for the markets, with the VIX, Wall Street's so-called fear gauge, up by around 145% so far this year. Joining me to discuss how to trade these choppy markets is Serge Berger from thesteadytrader.com, who is in Zurich. Serge, great to see you as always. Let's get into some of your charts, starting with the DAX, which is now in bear market territory, down by more than 20% since the sell-off began towards the end of February. We have been seeing a little bit of a reprieve over the past session or so. Talk to us about your outlook. Have we hit the bottom?
Yeah, sure. Hey, Victoria. I mean, I think for the most part, we are certainly much closer to a tradable bottom. And, these are processes, so we have to make sure we stick with it with our appropriate time frames. You remember, you and I had discussions over the past few months how we talked about things were unsustainably rallying on the upside with low volatility, and mean reversion was due. So if we look at the DAX chart here, this is a multi-year chart with weekly increments, and you can see it kind of do these quasi-regression lines. And basically, it's almost to the euro cent, I guess, in this case, where we've reached the upper end of the trend, and now we're basically overshooting the downside. Now, it's very common to overshoot a little bit and to undershoot, but I think we're getting closer here in the DAX. Anything around 10,000, 300 to 400. Again, these are very volatile markets, to your point. So you have to look for areas as opposed to very specific to the cent sort of levels. But I think at this point, what you want to do, if you're super active, you want to look at your daily charts or even more. But I think for most people, you want to focus here on the weekly time frames and see if you can get a real flush out and with some sort of follow through buying to the upside. But I think anything around 10,300, 10,400 is kind of where you want to look for this first area of support to really hold, because again, we've broken support, but we're really also coming into horizontal support from a simple technical perspective.
So broadly, you're suggesting that price action is likely to remain within that upward channel. Is that what you're saying? We're hitting the bottom right now, and we could see some upside to come.
I think we will see bounces. The ultimate judgment is still out there whether we're entering into a more meaningful bear market and then actually recession. I'm certainly in the camp that there's about a 60% chance of that happening. If that happens, we will likely then make lower highs, whether it's the DAX or many of the other indices that one can look at. But I think for now, it's more of a finding an area to bounce and make some tradable gains.
So what would you be looking for in terms of levels to suggest that we are rolling into that bear market? Or is it likely to come more from the fundamental news if there are signs that there is a global recession, for example, on the horizon?
Yeah, so I think the way that what we're doing and with our money management business and everything that we do, what we're looking at here is really more of a tradable bounce to maybe get, in DAX terms, maybe get us towards 12,000. It certainly could be more. And the way this could happen is if you get some sort of marginal positive news that the spreading of the virus is seeing a rate of change decline, like we're seeing already, thankfully, in China and a couple other parts of the world. And I think that could be the bounce. Of course, then once you start getting economic data coming in and actually representing what's happening right now, which is essentially an economic standstill in a lot of things. I just had to cancel a flight too, unfortunately. And I think then you get another swoosh lower, and then maybe you start working on a sort of bigger kind of bottom through the lens of a couple of months or so.
Okay, so let's talk about US equities then, because we saw that the S&P had its best one-day performance since 2018 yesterday, but it wasn't long ago that we were on Monday's price action that saw the S&P down by nearly 8%. I think it was its 7th worst decline on record. And if we're talking about market breadth, this really wasn't confined to a few stocks like we saw in some of the later rallies towards the end of the bull run, last month and the month before, when a lot of the gains were confined to the tech sector. This really was a very wide move in terms of the fact that all stocks across the index were hit. Tell us about how we should be trading the S&P. Is it kind of similar to how we should be trading the DAX?
I think there's certainly rhymes here, and so again, you and I talked about this plenty of times in the fourth quarter, and then into January, February of this year, that this overshooting move in the S&P was simply not sustainable. We talked about the Microsofts and the Apple being 50% of the Nasdaq 100, which is completely insane, and 10% of the S&P, and from these boring moves come fast moves, and they're really what they are is mean reversion moves. I'm not necessarily in the camp that we're going to go into a financial depression again like we had in the 08 or 09-ish period, but I think mean reversion moves are a very, very real thing. So at this point, what you need to understand is we have a mean reversion move. S&P anywhere in the 2730 area is kind of the lows, but we can definitely head into the 2600 to 2650 area, where we ultimately have, at least technically, have better supports. But again, like I said before, you can have, just like we had overshooting here in January, February, there's no reason why we can't undershoot here at some point in the near future. But I think, again, from a trading perspective, it's the same thing. You look we are extremely oversold on a daily basis right now. So just give you some perspective on this. On the daily chart, you can see pretty much any measure you look at, whether you're looking at MACDs or RSIs or how many stocks are above their 200-day moving average. You take VIX into account. We are very oversold, and I think we could definitely bounce. We could easily bounce towards 3,000, maybe a bit more, very, very, very quickly. But again, I think the bigger picture data points that we need to wait for are going to come a little bit later on in the coming months, and that's where we can certainly see another move lower. Potentially meaningful so.
So I know obviously you play the options markets quite a lot, and I mentioned in my introduction the fact that we have seen this very sharp rally in terms of the VIX implied volatility on US stocks since the start of the year. Where do you stand on the outlook for volatility? Are you short in some of your strategies?
Yeah, so most of what we do in some of the more active portfolios is really basically we're net sellers of options. And, one would think that works a lot better when volatility is high. And I'm here to tell you it doesn't really matter much because it's just the odds are so much in your favor. When you look at the VIX, and I brought up a chart here, this is a daily chart, but I think you get the point. For the most part, when you get a VIX above 40, it usually doesn't stay there very much because volatility is mean reverting, just like stock prices tend to be, at least in their respective trends. Yeah. But with the VIX, I mean, it's at this point, if you look at this through at least a multi-week lens, the odds, historically speaking, are very, very, very high that the VIX will get back down into the low 30s, probably the mid to low 20s over the course of the next few weeks. So being a net seller of options, preferably option spreads, is really the thing to do here from a probability perspective.
Okay, now obviously coronavirus has been one of the key drivers for the volatility over recent weeks, but obviously on Monday we had that Black Monday, which was driven by gyrations in the oil market, that massive crash, and that was because of tensions between Saudi and Russia. Saudi Aramco just today has been asked to raise its capacity as well, and that's really heightening that oil price war. Talk to us about your view for the oil markets.
Yeah, sure. I mean, I think there's a couple important points I think I want to make about oil. First of all, and we can talk about price. And I'm going to just pull up a weekly chart. And, this is, again, where perspective really matters. Oil, for people who don't follow this too much, has been in a bear trend or a downtrend for years. So this is nothing new. What is new now is that we're getting into territories that historically, from a price perspective, anything in the $30 area has been support now for a decade, and it used to be resistance. So if you go back to 2002, 3, 4, around that area, that was resistance, and now it's becoming support. So I think the odds are quite high that we are going to hold these levels again. Unfortunately, with the high volatility, you got to give this like 5 points or so we could easily dip into the mid-20s, would not at all surprise me. But I think the odds are quite high that we are going to bounce here quite meaningfully. I think the more important story, and this is really kind of a side point, but it is a major point, is this chart that I'm bringing up right now, which takes the price of oil up here represented by an ETF and down here by junk bonds. And the junk bond market is essentially, a large part of it is is oil-related stocks. So you can see the correlation between these two. So as oil starts to have essentially, below 30, below 40 really is I think for a lot of people a problem. People are going to default, particularly in the U.S. Shale industry there. And so the junk bond market is probably going to be a bigger problem. That doesn't necessarily mean the price of oil can't bounce, but it's going to probably cause and continue more volatility in the price of oil and around the entire story that we have.
So just to be clear, where do you think roughly we could see the bottom for oil?
I think you could easily dip towards 25. Again, from a long-term weekly perspective, there's not the slightest problem, but I'm not quite sure we have what it takes to stay down there for very long. So anywhere within the 25 to even the $30 area is to me where I would think we should be able to get a bounce, even if it takes a few weeks to ultimately get that bounce.
So would you be comfortable buying around these levels, or would you be waiting for the move back down to 30 or even 25 before you start entering a long trade there?
Yeah, no, I think it depends on your time frame. If you're very, very quick, I think one could wait. If you have a time horizon of a few weeks or maybe a couple of months, which is what what we're telling clients to do, then I think at these levels, legging in is in our opinion is okay. Again, small size given volatility in the markets is what we're doing.
Okay, let's talk about cable finally, because we can't really not mention it given the fact that we did have this emergency 50 bips rate cut from the Bank of England just today. Interestingly, cable is actually up on the day. Is this just a case of travel and arrive? Do you think people are sort of getting out of those positions and it was already essentially priced in?
I think it might have been priced in. I think the bigger picture here is really that of we're going back to, and I don't like to use the term, but I'm going to have to use it because essentially it's what's happening. It's currency wars, whether that's on purpose or it's a function of, global economic growth slowing, which we've been pounding a table on for the past 12 months, or it is, the coronavirus related situations. It's all the same story. So, I think when you look at these currency pairs, particularly cable, it is probably going to be a tug of war because the Fed is probably going to drop rates again next week. At least that's in my opinion. And obviously we saw what the Bank of England did today. So I'm not quite sure there is a whole lot of directionality to this move. What I will point out is that you have the bigger picture trend, which basically continues to point cable to the downside unless we were to break above about 134.5 and change, in which case you could start accelerating that move to the upside in a meaningful way through a multi-month, multi-quarter, maybe multi-year lens.
And just very finally, kind of on the other side of the ledger of the cable trade, just your view on the dollar. I mean, we know that it has been strengthening over the sort of medium to long term since the start of 2018, roughly. Donald Trump clearly always one of his bugbears wanting the currency to be weaker for the international trade benefits. Do you think that what we're seeing in terms of the Fed's aggressive action and the fact that we've got the concerns about the coronavirus and we're in an election year, all these kind of fundamental drivers could potentially point to downside for the greenback?
I think it's now more limited than it was before. So, I think a lot of this has to be taken into the difference between yields of, say, 10-year bonds and 10-year treasuries has basically collapsed over the past 2 weeks, with yields on the U.S. 10-year going from anywhere from 1.6% down to as low as 30 basis points the other day, these are completely amazing moves. So, the propensity for say European money and other low interest rate environments to move into treasuries has certainly slowed down. So while I think the dollar could see upside from an economic perspective and everything, I'm not quite sure that the big upside or the big downside is really there anymore. So a little bit similar to what I'm seeing in cable, where again it's the interest rate wars, or really it's the currency wars indirectly because of interest rates. I think at this point with the big move in treasuries, to a good extent, has certainly been taken off the table or at least slowed down.
Serge, thank you so much for your time.
Thank you.
That was Serge Berger from thesteadytrader.com. I'm Victoria Scholar, and thanks for watching IGTV.